Right now, Lemonade Inc. is trading at $71.20. That is a staggering 21.46% up for the day, a move of over $12.50 on the session. Now, before you jump in and say it's just another short squeeze or it's a dead cat bounce, you need to understand what's really driving this. This isn't just noise. This 21% surge is forcing a fundamental recalculation of what this company is worth, and it looks like the big money is finally waking up to a reality that many retail investors and, frankly, many analysts have missed for months. This isn't just a blip, it's a potential reassessment of the entire InsurTech space, and Lemonade is at the very center of it. Let's be completely honest. For the past 2 years, the common belief, the overriding expectation about Lemonade has been overwhelmingly negative. The narrative was set. This was a classic 2021 story, a company with a slick app, a clever name, and a business model that hemorrhaged cash. People saw it as a story stock, grouped in with other high-growth, no-profit names that got absolutely decimated when interest rates started to climb. The stock was, for many, a cautionary tale. A lot of investors, perhaps those using the Robinhood app or SoFi Invest for the first time, got completely washed out, expecting a quick double and instead getting an 80% or 90% loss from the highs. The expectation was that this was a failed experiment. But that expectation, that it's just a marketing company burning through venture capital, is colliding with a harsh reality for the bears today. The reality is that while the stock price was collapsing, Lemonade's core technology, its AI Maya, and its AI Jim claims bot has been quietly getting smarter, processing more data, and most importantly, getting better at pricing risk. The gross loss ratio, which is the single most important metric for this business, has been showing consistent sequential signs of improvement. This 21% pop isn't just retail euphoria. You have to look at the trading volume today. It is massive, multiples of its daily average. This is institutional. This is what happens when a major fund, maybe one managed by Fidelity or a specialized tech hedge fund, decides the pessimism was dramatically overdone and the core business model might actually work. This isn't a small investment move, it's a positional shift. A move this violent doesn't happen in a vacuum. We're seeing trading volume today that's easily 5 or 6 times the 3-month average. This is an accumulation day. This isn't just high-frequency traders on interactive brokers scalping fractions of a cent. This is a positional reevaluation. What's causing it? While there's no single press release, the momentum has been building. Reports are circulating about a potential analyst upgrade, or perhaps a delayed reaction to the last earnings report. Remember, their last report wasn't perfect, but it showed continued stabilization in that all-important loss ratio and significant growth in their in-force premium. The market largely ignored it at the time, but it seems to be pricing it all in at once today. The entire bull case for Lemonade rests on one simple idea: that artificial intelligence and behavioral economics can underwrite insurance better and cheaper than thousands of human agents and legacy actuarial tables. For years, the reality was that their tech was great at acquiring customers. The Robinhood stock trading crowd loved the easy sign-up. But their claims were often handled by another AI, Jim, which can apparently review, approve, and pay out simple claims in as little as 3 seconds. It's an invest online dream on paper. They also have a unique give-back program, which is core to their identity. They take a flat fee from your premium, use the rest to pay claims and buy reinsurance, and then donate any leftover underwriting profits to a charity of the customer's choice. This is meant to align incentives. They don't profit from denying claims and reduce fraud. It's a fantastic marketing angle, but for a long time, the business reality was that the leftover was often a loss. They've since expanded into pet insurance, life insurance, and critically, car insurance. The launch of Lemonade Car is the big prize. That's the market they must win to become a mainstream giant, not just a niche for urban millennials. So what happens from here? After a 21% spike, the natural expectation is for a sell the news pullback, and that's entirely possible. The bears will say this is a liquidity-driven spike, a head fake before a return to the 50s or 60s. They'll point out that the company is still not profitable. They'll say that legacy insurers have a float, billions and billions of invested premiums that Lemonade doesn't, and in a high-interest rate world, that float is a massive advantage. They'll say Fidelity mutual funds focused on value will never touch this. But the reality for the bulls, the one being priced in today, is that this could be the start of a major re-rating. The catalyst we're all looking for is the next earnings report. If Lemonade can show another quarter of sequential improvement in its gross loss ratio, especially in its newer and much larger car insurance product, this $71 price will look cheap. The car insurance market is massive, and that's where the Fidelity and Vanguard-sized funds will get really interested. They don't just want a cool app. They don't care about the Fidelity mobile app experience. They want a path to billions of predictable, profitable premiums. Lemonade's acquisition of Metromile was all about accelerating that. It gave them a treasure trove of driving data, state licenses, and a foot in the door. We are now finally seeing if that bet is going to pay off. The risk? It's simple. Cash. They are still burning it to fund their growth. If their underwriting improvements stall, or if this spike in the stock proves temporary, they may be forced to raise capital from a position of weakness, diluting shareholders. This is a high-wire act. This is not a buy it in your Fidelity IRA and forget it kind of stock, not like Apple stock. It's a speculative growth play. It requires active monitoring. This isn't for an intelligent portfolio that's set on autopilot. Many people who trade on Robinhood or SoFi have learned this the hard way. But for those with a high risk tolerance, the potential upside is asymmetric. And that's exactly what today's 21% move is communicating to the world. So, to wrap this all up, the 21% surge to $71 today is a powerful rejection of the simple, lazy bear narrative. The expectation was that Lemonade was a failed, growth-at-all-costs story from a bygone zero-interest rate world. The reality hitting the market today is that the company's underlying AI-driven underwriting model might actually be working, and the relentless quarter-after-quarter improvements in their loss ratios are finally being recognized by serious capital. This isn't just noise, it's a signal. The question is no longer, is this a cute idea? The question is this the moment the AI model proves it's superior to the 100-year-old human-based model? Today, the market placed a very large, very real bet on yes.